Hey, good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. I apologize for the couple of minute delay in getting started, but we were having a little bit of technical difficulty, but we are up and running now. So we start off this week um, with obviously escalating geopolitical risks out of the Middle East, with significant volatility in oil prices. You have oil prices back up to around $74 after what was a sharp spike on Friday, reflecting kind of fears around supply disruption. Last week, we had a pretty good week with regards to economic data. Inflation came in slightly better than expected. It did rise to 2.4% year over year, which is slightly up from April, but it was below expectations. So, you have the S&P 500 that's now closing in on the all-time highs around 610 or so. We're about to open up here just shy of that 610 level here. Um, at the moment, some of the concerns that we raised over the last couple of weeks with regards to the bonds, with regards to the bond market, um, seemingly has receded a little bit with regards to those fears. We had a good 30-year auction on Thursday last week. Demand on that was quite strong. And then we had another 20-year bond auction yesterday. Similarly, the demand on that was quite strong here as well. So clearly, demand for treasuries have not quote unquote cracked recently, even though there are still some signs from the bond market that foreign investors are not buying up treasuries at the same clip that they historically have been doing so. And that is still a major risk here for the bond market. But, the two long dated bond auctions here at the end of last week and this week both went quite smoothly, and to some degree alleviate some of the overall fears, at least in the short run, with regards to the sustainability, if you will, of the debt trajectory that this country is on with regards to um, the size of the treasury debt that's outstanding and the amount of tax revenue that is now going towards servicing that debt has increased significantly in the last few years. Nearly 25% of all tax revenue now is going towards just to service the $36 trillion worth of debt. And with 10, 20, and 30-year yields kind of back near 52-week highs, it just makes servicing that debt more expensive and more costly to taxpayers, which erodes what tax revenue can be used for with regards to social services, with and is becoming of more and more concern for investors. But like I said, in the short run, um, economic data continues to be relatively robust. You have job numbers that came out at the end of last week. That was quite strong, with revisions for the previous couple of months still showing some signs of slowdown in the labor market, but fairly resilient in the labor market. Inflation continuing to tick in the right direction. It starts to bring into the question as to whether or not the Fed should be cutting interest rates, given the fact that inflation is moving in the right direction. The FOMC meeting is tomorrow at 2 p.m. Market participants right now are expecting rates to remain unchanged. I think that there's a very low probability of a rate cut here tomorrow. And that's really because there's still concern that the tariffs might lead to some level of uptick in inflation. So the Federal Reserve is choosing to be more patient and waiting this period out and seeing a few months worth of data. So right now we've seen April and May data. I'm guessing they would like to at least see one more month of data where inflation is still continuing to tick in the right direction before they look at cutting rates. And at the moment, the bond market is pricing in the first rate cut in September and the second one in December. And that's still the case. So overall, you have the S&P 500 approaching that 610 level here. We talked about a little bit of negative divergence here last week. So far, we got a little bit of a pullback here on Friday's news that Israel has started to attack Iran. But so far, the market has kind of shrugged off some of those concerns at the moment and kind of continuing to march onto recent highs. You see that on the NASDAQ 100 here as well on QQQ. You see the fact that similarly to SPY, we're continuing to push towards those all-time highs. We're just within spitting distance now of those all-time highs, and that looks inevitable right now that we will tag that all-time high and continue to break out above it. When you look at IWM, small caps, similarly, we have small caps recently breaking out to above a major resistance level here, and we are looking for a potential continuation here from that. Small caps obviously weaker than the mega caps, but it did recently break out here above that 210 level, coming back to retest this as support, and we're looking for a continuation higher here. The only index that I think at the moment is still lagging behind right now is the RSP equal weight S&P 500 index. As you can see, the equal weight S&P 500 index has not broken out yet above this 180 resistance level, which really shows us that participation on this rally here is not that strong. We really would like to see that breakout here above that level to confirm the bullishness that we're currently seeing here in the markets. I think we'll get there, but at the moment, we're not quite there just yet with regards to the participation here of the broader rally in this in the rally here for equities. When we look at bonds here, look at HYG, note that HYG continues to make higher highs and higher lows. So we continue to have, the riskier side of corporate bonds continuing to rally, meaning bond investors are not concerned about an overall credit risk. And that continues to confirm a more risk-on environment for equities and gives us kind of a little bit more of confidence from the bond market that equities can continue to push towards those all-time highs and potentially even higher from there. The one thing that I do think we need to pay attention to here are longer dated bonds and how those are responding here at the moment, because as you can see here, yesterday, we continue to sell off here, which means yields got pushed a little bit higher. So, long-term bonds continue to trend in a downward direction here. So if you look at this particular trend line, it's been respected multiple times here. The downside here is around 83.5. That's our downside target here for TLT. That looks like we might be revisiting those 52-week lows on TLT, which would respond to around a 4.5 rate on the 10-year and a 5% rate here on the 20 and 30-year. And that, in my opinion, is probably the biggest overall risk that we have here to the equity markets. Are bond markets kind of being more concerned around the credit quality of U.S. Treasuries and what that means, what ramifications that has in the long run. And the equity markets at the moment in the short run have largely shrugged off that risk and kind of chosen to ignore that risk right now and continue to march on to those all-time highs. But I think that as equity investors, it is very important for us to be diligent and pay attention to what the bond markets are telling us, because ultimately the bond market is much, much larger than the equity markets from a size perspective and will ultimately have a bigger influence on the overall sentiment and direction of equities if the bond market starts to panic. So for those reasons, I think it's really important for investors to stay aware of what's going on with the bond market, taking a look at where bond auctions continue to, there's demand for these treasury bond auctions and seeing kind of how healthy they are. Because if you start to see some of the quote unquote cracks that Jamie Dimon a couple of weeks ago referred to, those are potentially some signs that the equity rally is potentially coming to an end. So, make sure that you are familiar and have a way to kind of view and track what the bond market is saying here on a weekly basis at the very least. Okay, so looking at trade ideas here for the week, given kind of where, sorry, given where the S&P 500 is currently trading, where we are just within spitting distance of the all-time highs, given the fact that the S&P 500 has rallied over 25% in 2 months' time, which is one of the fastest rallies we've seen over such a short period of time in history, there are, there are definitely signs that, the rally is somewhat exhausted, that that buyer momentum is not quite there, and that the risk to reward skews a little bit more heavily towards the bearish side of things. I think in this type of market environment, you really only want to be long your highest conviction names at this point. And what I mean by that is I don't think, trying to establish new long positions after the market has rallied to over 25% in 2 months' time, it's a really tough market to play, because you're basically saying I'm going to buy high and hoping the markets will continue to move higher. And that, that there's nothing wrong with that inherently, because markets can do that quite often. But the risk reward, in my opinion, skews more here to the downside. So maintaining bullish positions here in this market, in my opinion, has to be in some of your most highest conviction names. So what I'll do is I'll walk through a couple of them that I think are worth paying attention to. First one is Microsoft. Microsoft does trade at around 31 times forward earnings, which is a premium relative to the industry. However, we have to remember Microsoft is one of the few stocks in the S&P 500 that has net margins north of 35%. There are very few stocks that have net margins north of 35%, but as it recently broke out here above this $46 level, and also you can think of this as the 450 level here that it broke out here. From my perspective, I really like Microsoft in the long run, especially as an AI play. They have about a 35% market share of AI kind of compute, and they are definitely the leader in this particular space, and I genuinely believe we are just in the very early stages of kind of how AI will revolutionize the way we interact with technology in the future. And that is going to have to be powered by servers, and Microsoft is the leader in the hyperscale AI infrastructure space. And for those reasons, I think Microsoft deserves to be in most long-term portfolios if you agree with that overall assessment and the theme of AI. It is a little bit on the expensive side at 31 times forward earnings, but it is well supported with the relatively thick margins that Microsoft commands of over 35%. And the growth rates, that exceed the industry average, supports the, slightly elevated valuation at 31 times versus the industry is closer around 28 times. So it's not much higher in terms of valuation than the industry, but it is a little bit higher. But again, I think that valuation premium is more than justified given the fact that it grows faster than the industry and it's far more profitable in the industry. But I will say, my preference with being liking Microsoft is that I do want to see a little bit of a pullback here, where I think the risk reward looks a lot more favorable to add some long positions rather than adding at these 52-week highs. but I do think Microsoft is one worth paying attention to. Another stock that we talked about here last week, if you were here, is Micron. Micron is the supplier of many of the memory chips that go into NVIDIA GPUs. So if you look at kind of this 110 level here that Micron recently broke out from, this really starts to target 135 here to the upside. That's our upside target, short-term upside target here for Micron. Looking at that, whoops, sorry, I scrolled a little bit too far. Looking at that 135 level, that's kind of our immediate upside target. If we can get to 135, that really starts to look quite interesting for Micron. Micron trades at around 10 and a half times forward earnings, which is much cheaper than the industry average from a semiconductor space. It is, I would say, slightly above average in the memory space, which is where they operate. But Micron is expected to grow far faster than its peers, and continues to have healthy margins around 15%. Versus the industry average around 10.5% in terms of net margins. So the fact that it's more profitable, grows substantially faster than the industry, yet it trades at a valuation that's just above average and well below the average for the semiconductor industry, represents what I believe is one of the alternative ways to get exposure to the growth of AI without using kind of some of the more obvious investments like NVIDIA or Microsoft, and being able to purchase it at a much more reasonable valuation than what some of those other companies are trading at, which are just slightly higher. Even though I still think that they're justified, they are still trading at a higher valuation compared to Micron. And the last kind of bullish idea I'll leave you with that I think is worth paying attention to here is Pinterest. Pinterest, a few weeks ago, reported stronger than expected earnings. The stock has continued to kind of break out higher from here. And you can even call this a little bit of an inverted head and shoulders, however you want to call it. But it did again break out here above this $33 level here, broke out, came back to retest that support, and now is looking like it's going to continue moving on. Our upside target here for Pinterest is around $40 or so. That gives you still a good amount of upside here, around closer to 12-13% upside from where we are right now, looking at Pinterest. Pinterest still trades at a relatively reasonable valuation as well, and net margins are incredibly healthy, which is why we like Pinterest here to the upside. Now, looking at some bearish opportunities here right now, I think it's worth paying attention to right now. The first one I want to take a look at here is Walmart. Walmart is a new idea that we added to the bearish list here this week. As you can see, the stock, after attempting to break out here above 100 back here in February, where it failed, it has now failed at this 100 level 3 more times recently. So my expectation is that this will trade back into this range, back to the bottom of the range, which is around $90 here to the downside for Walmart. And if you look at kind of valuations, Walmart trades at 36 times forward earnings. This is the grocery store, arguably the world's largest grocery store, but still a grocery store nonetheless, which operates at razor thin margins. We're talking about 2.5% are its net margins. And when companies operate at such thin margins, that's really where there's a lot of risk in this type of market environment where, this is a company that sources the vast majority of their goods from a single country, which is China. The trade war with China, I would say, has a lot of geopolitical risks overall. And for those reasons, I think Walmart is, at a high amount of risk given the valuation that it trades at. 36 times forward earnings with such thin margins is really, really risky in my opinion. And on top of that, Walmart's not expected to grow any faster than the industry. So, when you're not growing any faster, you're raising thin margins and you're trading at a valuation that's double the industry, there are some downside risks in this market environment. And I think that this is worth taking a look at on the bearish side. The next one I want to take a look at here is Apple. I've been pretty vocal about Apple here for what feels like months and months and months. Pretty much every single opportunity that Apple has rallied has been a selling opportunity for us here at Options Play, and I think that this recent rally here is no different. I think Apple is potentially at the short run headed down to this 175, 170 support level here. It still trades at a pretty rich valuation at 26 times forward earnings. The only thing that sort of justifies its relatively premium valuation, trading at 26 versus 18 for the industry, is the net margins. Apple's net margins largely have been maintained around this 24-25% range. But I do think that that margin is at risk, again, with the tariffs out of China and just the overall market environment that we find ourselves in, I think is going to be challenging for Apple, especially since iPhone sales continue to disappoint and their rollout of AI they've really botched their rollout here for AI, to the point where they're not even expecting it in the iPhone 17, even though they promised it, or rather marketed as part of what will come with iPhone 16. So they've really kind of changed their tune on Apple Intelligence and AI and kind of how they plan on integrating it. Right now, it feels like they are very much lost in that regard. Not to mention kind of their big bet on the future, which is augmented reality, so far has not been the huge success they were hoping for. And this is really where Meta and Snapchat are to some degree eating its lunch, even in the AR space, which they technically have a product for. That product is unfortunately not growing. Now, I don't want to count Apple out by any means. With 2.6 billion devices and in people's hands, they wield a lot of power. I have faith that they will sort out their AI issues in the future, but in the short run, the downside risks, I think, are greater here for stocks like Apple. And I will leave you with one last one, which is T-Mobile. And looks like T-Mobile pre-market was down about 4% here. We did talk about this stock here last week as well. But T-Mobile, as you can see, is starting to break below some major support levels here. And like I said, pre-market here, we are below those levels. So it looks like we're going to be able to fill this gap here from at the beginning of the year. If we can break below that gap fill, then we start to head significantly lower beyond that. T-Mobile trades at a pretty rich premium. It's trading at 21 times forward earnings, which is double the industry average. Now, when you see those types of valuations, usually you see growth expectations that are far faster. You're expecting to see profit margins that are much higher, but they're not really that much higher. Yes, both expected growth and profit margins are a little bit higher than the industry average, but I think that's hard to justify a valuation that's double the industry valuations. So I believe the news this morning was that SoftBank sold their entire position here in T-Mobile, and that's why the stock is down around 4% pre-market here right now. But I think that there potentially could be further downside in this particular stock. So with that, that covers what I wanted to share with you here for today. Hopefully that gives you a good understanding of what my views are here for the broader markets, what are some of the trade ideas that we have here for the week, and enable you for trading. With that, thank you so much. I hope you guys have a great trading week, and I'll see you guys here next week.